Good evening, friends. I welcome all for the fifth webinar of corporate professional in the stressful era of COVID-19. We received a very overwhelming response from participants, and we got registration of 883, and people are joining. This particular program we are organizing for the benefit of India Inc. As I told in other webinar, COVID-19 has changed the entire world. It is destroying so many things, but simultaneously it is creating so many new opportunities also. Various front we are losing, but various front we are creating also. New innovative systems, new innovative process seeing the light of the day. Today's program is also very important in the same issue where every company is facing new types of problem because that is called liquidity. Not a single business is affected by this. They don't have business. The business activity is suffering, but their fixed cost is remain same. And the most important cost of fixed is employee, which is very essential. So you can't leave it and you can't sustain it also. So what is the solution? So Esop is one of the solution which we have identified. And that's why if you see this, Esop is not a new phenomena, but Esop in the COVID era is a phenomena which we have to understand and use it for our benefit. In today's program, we have three speakers. We have requested Madhav Keswani, who is the head rewards and benefit of Aditya Birla Group. Madhav, he has 20 years experience in performance management and rewards and benefit. His area of expertise including executive compensation, variable pay plans, design including ESOP and benefit. Madhav consults various business and diversified conglomerate of their rewards and benefits strategy and policies of Aditya Birla Group. He continued to build focus on people, investment and reward strategy to complement the plan of the group. Prior to joining Aditya Birla Group in 2011, he held various senior positions in Standard Chartered Bank, Watson Wade, now it's a Tower Watson. And Madhav is interestingly, he's looking after reward and benefit, and which is a part of the HR. He's a chartered accountant, so he knows the in and outs of the rewards benefits intricacies. He's BCom from Mumbai University. I welcome Madhav, and he is the apt person to explain today because his group is a very unique group which contains listed company, unlisted company, and startup. So we will definitely get benefit from Madhav's experience and his knowledge. Welcome Madhav for this program. Then we have Mohini Vashne. He is a partner in corporate profession and looks after specifically the Esop division. Esop and Esop Guardian, which is a specialized software for the Esop. And Mohini looks after the Esop division where she frames schemes, planning, execution and implementation, 360-degree of entire Esop work. She will talk about what is Esop, how to implement this. Then another speaker is Chandar Sahni, who is a chartered accountant and he is a registered valuer and he's a company secretary also. Chandar is a partner in corporate profession and looks after specifically the valuation division. And when we talk about the ESOP, the valuation is one of the most important parts which has to understand, and certain parts of taxation issues which Chandal will explain. Friends, ESOP compensation during economic distress. This is today's topic. It is giving a new dimension to employees' growth towards their new things. Now, as you are aware that what is happening, current economic scenario is very, very serious. The business is closed, and today you can't claim that what are the situation after some time because there is no clarity. So major challenge is you can't forecast the demand, revenue and earnings. If you can do this, then the problem is supply chain is disturbed. Logistic issue is not efficient. And then the most important thing, if these two things are there, then recovery and liquidity crisis is too much. Now, what is the immediate need to review the cost overlays? Because these are the things, unless the business is going on, you cannot run anything. But the cost is remain there. Revenue are uncertain, but fixed costs are there. So you have to review fixed and variable cost to manage liquidity. The permanent employee are the fixed operating costs. They are no doubt cost, but they are the most important asset of the organization. So they are significant part of working capital and they require cash outlay. So the issue is that how you can think in this part. So employee cost is there. So what the organizations are doing, they are rationalizing employee cost. They are laying off, they are salary cut, they are doing salary cuts, they are restructuring their salaries. And such decisions are detrimental to the business. You are not deferring the expenditure, but you are cutting, because employee lose trust in the employer. And then employees' moral will also low, and that create ineffectiveness and the unproductiveness. Then business could miss an opportunity due to unavailability of resources, because if you will do this, then you will not work in that passion. Employee feel insecure and uncertain about the financial process. Organization restructure is inevitable. Significant part of working capital has to restructure. So the point is, the restructuring is inevitable, keeping in mind that you have to retain the talent and you have to retain the employee. So now ESOP is one of the surviving in downtrend, how the ESOP can take place. So the ESOP is a new normal, is a new phenomena in COVID era. ESOP per se is not a new phenomena, but using ESOP in this era is a new phenomena. We have to relook at the traditional compensation practice. We have to consider share-based compensation to employee through ESOP. ESOP is an effective way of using company which can defer. Now the important thing is, in ESOP, when you compensating in place of cash, you are deferring the compensation of your employee. You are settling the liability for in future, not today. You are making non-monetary compensation through equity payment, and then you are motivating the employee to run extra mile, so they can work extra mile for you. Now, what are the advantage of ESOP for employer? Because in place of cash, you are giving the equity. So minimize attrition with additional reward, because employee can steer employee towards organization vision. You can connect with the organization's vision. Freedom to channelize fund in other area, because the cost which you are incurring here, you can incur the other important area which is connected to production. Drives unparalleled employees loyalty. Employees will work for you because they also realize, because they are seeing the phenomena across the world, so they can feel that management has thinking about them. Then you can retain the trustworthy and those who are performing employees in your company. And then employee attracts who can potentially asset for the organization, because they cannot, despite of this, they cannot leave this. Now the question is, what are the entire advantage of for employee? Employees, he creates wealth as a equity ownership, because he feel part of the organization, because he is the owner, he's in the equity ownership. Whether it's a percentage is 100 share or 500 share or 1000 share or 1 lakh share, but he feels as a part of the ownership. He professionally growing by creating tangible value, because ultimately that will give some monetary benefit. Job security improves. Stock monetization or exceed the regular remuneration. So if the stock market is going up, his value will also go up. And drive direct benefit from acquisition and strategic investment. So now all these things will be helpful for the employees. Now friends, when you see ESOP, ESOP is not only just 4-letter word. In today's session, we will discuss employer, startup, listed company, employee. Restructuring mode, ESOP, ESPP, RSU, SAR. Implementation mode, direct route, trust route. We have to see the cycle of ESOP, create, implement, grant, vest, and exercise. Various departments which are connected with ESOP, human resource, legal, secretarial, account, and taxation. Various criteria which we'll discuss, quantum, pricing, taxation, vesting, and policy. Methods, accounting standard and valuation we will discuss. Various regulation which are a part of Companies Act, SEBI, LODR, SEBI stock share benefit employee scheme, SEBI PIT, the price related things, SEBI SAST, income tax, and FEMA. All these things we will discuss. And it's not only 4 words we are discussing whole lot of things in this. Friends, I will hand over to Mohini, and Mohini will take over and will discuss about ESOP, how ESOP work, how ESOP, the ESOP implementation scheme, various modes, practical aspects, why now ESOP is important, ESOPs, the process, regulatory issues, accounting, taxation, and ESOP and taxation that she will discuss. So hand over to Mohini, and Mohini to start, and you can understand what is ESOP. Mohini will explain each and every aspect of ESOP, and the program structure will be like this. After Mohini, Chandra will speak on valuation, and then Madhav will share his practical experience, and then I will open the house for the questions. We have received various questions, and in the meantime, whatever questions coming in your mind, you can send it to us. All questions we will reply during this period. Thank you very much. Over to Mohini. Please start your understanding ESOP.
Thanks, sir. Thanks, Pavan, sir. So, sir has given a very beautiful insight on why the employer has to look right now for the various other ways for implementing and for giving the compensation to their employees. So one of the way which rightly said that in cash, ultimately what you can replace it with is a kind. Kind means what in the business, the kind easily is, that is the equity, which is not only the equity, it is the ultimate growth value which we are going to share with the employees. So now when we are talking about ESOP, so what is ESOPs and all? So I'm going to take you through all these things. So starting with, so what is ESOPs? So ESOPs is a whole, ESOPs are comprising of employee, stock, option, plan. That means employee, permanent employee. Stock means that you are sharing equity shares of the company. Option, it's an option, not an obligation on the employee. Also, it's an option to purchase the equity share at a later date. Plan, it's not a short-term plan which we are, an objective which we are going to achieve through this ESOPs. We are going to achieve a long-term incentive plan for through this ESOPs. So ESOP is a 4 letters we can think in this ESOPs. Now, how the ESOPs work? ESOPs has a various stages. The first stage is definitely a formation of an ESOP scheme, which that means wherein you are deciding the various factors which I am covering later in the part of my presentation, that what all factors you need to consider when we are framing an ESOP scheme. Once you have done with your ESOP scheme, you're ready to launch your policy. The second step is the grant of option to your employees. That means offering of the options to the employees. Vesting of option. So grant of option is always be with some terms and conditions which the employee has to fulfill. So that terms and condition and the stage is known as the vesting of option. Grant, at the grant stage, there is no right with the employee to claim the shares of the company. After completing the conditions, that is during the vesting period, the vesting of option, that means the right comes to an employee to claim the shares of the company. Now, once the right has achieved and right has accrued to the employee, now what he can do is, now he has to convert those right into actual equity, so he can exercise his right, and that is known as the exercise of option. This is also one of the period which we need to give to the employees to exercise the options. Last one is because till exercise he is getting the shares. He has realized he has got the value and the incremental wealth creation in their account. But now ultimately when he is actually realizing them in the terms of the monetary benefit, that is the after allotment, that is the sale of the equity shares. So once the exercise, company will allot simultaneously when he exercise, and ultimately he sales and sales his shares and get the real benefit of the ESOPs. So these are the stages. Next comes is who are the employees to whom you can cover under the ESOP. So definitely there are a lot of questions when any company is planning any kind of scheme. So what are the eligible employees are? So employees are employees covered. They are the permanent employees. You can cover your whole-time directors, that is the professional directors, and you can also give the non-executive and non-promoters directors. Who are not covered? The not covered employees are the contractual employees. That means the person, there are many of the today in the senior most position, the people join as a on a contract basis or as a consultant to the companies, that definitely you cannot cover under the ESOPs. Then independent directors at all not covered under the benefit of the ESOPs. Any director holding more than 10% of the capital, that is also not covered. And definitely all the promoters, employees and directors who are related to the promoter group are out of the coverage of the eligible employee list. So these are the employee list to whom you can cover under the ESOPs. Now there are various ways of implementing the ESOPs. So there are routes, not ways, there are the routes. The first route is the direct route and the second one is the trust route. So what is the direct route per se in the ESOP? So direct route is that wherein there is no mediator in between. Company directly gives options to the employee. Option is exercised by the employee and the company is directly issuing the shares to the employee. So it is the direct route, no mediator in between. Another one route is the trust route, wherein we have created a one person, one channel, that is the employee welfare trust. ESOP trust, which otherwise known name is. So what in this structure the company is doing, that the right of grant of share is definitely with the company. Company created trust wherein they park the trust will park the shares for the employees, and whenever the employee exercises, employee will go to the trust and can claim their shares, and the shares will be transferred from the trust to the employee. There are various other benefits of the trust. So it's easy, we have a cashless mechanism through the trust, and for the unlisted companies, private limited companies, also trust has a many benefits. So trust route is one of the ways. So there are two routes. One is a direct route and another one is the trust route. Now, other benefits of the trust. So how the trust is going to acquire the shares, as earlier stated, the trust will park the shares for the employee benefit. The first is the secondary market acquisition. That means trust can acquire the shares from the market in case of a listed company, and in case of an unlisted company, definitely it can get the shares from the promoter or any exiting equity investor or any shareholder also. Another point is that he can also acquire the shares directly from the company. That means instead of directly allotting the shares to the employees, the company can allot the shares to the trust, and then the trust will transfer the shares to the employees. So these are the two ways how the trust can acquire the shares. Now it comes that what are the various other modes and various other names of the ESOPs. So ESOP is a brand, a brand, or you can say it's a big name, that ESOP. Under its umbrella, there are other forms of the equity linked benefits. The first equity linked benefit is you have heard about these terms: SAR, RSUs, and cash settled, that is the phantom stock. I cover a little bit of all these, what all these three terms meant to be. SAR. What is SAR? Stock, by name itself, it's a stock appreciation right. That means whatever is the increase in the value of the company, ultimately it be settled. Ultimately it be settled with the with the equity. With the equity. So what we are doing is stock appreciation right. We are settling that in the form of an equity. Next one is the restricted stock unit. What is the restricted stock units then? In the restricted stock unit, what we are giving is it's a shares which are given at a certain level. That means it's a restricted. That means it is not given to everyone. It will be given on the verge of either a goodwill, that means either a completion of some term of service in the organization, or upon completing any kind of performance. So these are the two conditions generally in the RSUs are, once the company, once the employee fulfill those two kinds of things, then the stock units will be given to the employees. Then it comes the phantom. Phantom is a cash settlement of, you can say, of the SAR. That means whatever is the stock appreciation in the first thing, settling in the equity, we are settling that thing in the form of a cash. So in the form of a cash, if we are settling, that is the phantom. I little bit explain more about the phantom is that in the phantom, what happens is that appreciation, for example, today's value is 100, and at the time of exercise, that means at the time when the employee wants to exercise his right, if the value comes to 200, then whatever is the 100 appreciation in the value of the equity share will be paid in the form of the cash. So it's a cash settlement from the company's account. So it's a phantom. Now, all the ways, all the types, all the modes which we have discussed. So the point comes is that what the first stage of it is the formation of a ESOP scheme. So what are the practical considerations involved in formation of any kind of ESOP schemes? So first is definitely the question comes in the mind of the management, employee coverage. That what I keep as an eligibility criteria. There are various ways you can define that thing also. It's in your hand. It's a selective or widespread, definitely. You can make depending upon that how much dilution you want and how many employees you want to start with. Many the companies start with selective one, and later on they can divide it into widespread also. It's a vertical or it's an horizontal dissemination, definitely. And whether we what discrimination we make in between the operating function and the support function. So these are the employee coverage. And then when you have decided that what employees you are covering, then point comes that what objective you want to achieve through this ESOPs. Whether you want only the employee to be a part in your appreciation, whether you want to give a particular percentage in your equity or a percentage in your wealth. So then depending upon that, we decide on that whether we go for ESOP, whether we go for SAR, or if there is any other particular objective, we can even opt for the RSUs. Then it comes that what exactly the share pool we will kept aside for our employees. What will be the promoters in that case, and founders will keep. So there is no limit at all. It's depending upon the company's capital size. In a small company, it may be a 10%. When the company grows, your equity grows, it might be led to only 1% or 0.5% also. So there is no limit, legal limit. You can decide depending upon how much benefit you want your employees to be a participative in your company's growth. Then it comes that so pool we acquire from fresh allotment secondary, that you can check through the various modes how you want. When you are going for the secondary market, definitely there is no dilution of the promoter and founders wealth. But if you are going for the fresh allotment, there is a dilution in the promoter and the founders equity. So that is a very important criteria when the company is deciding upon the pool of the option. Then comes, we have given the ESOPs, but now what the employee has to complete when he can claim the shares of the company. So that is known as the vesting period and the vesting criteria. Nowadays, various kinds of things are coming, that vesting conditions can be loyalty based, performance based, market based, mix of any of the three conditions. Performance again can be divided into the organization performance, individual performance. We can keep the percentage difference in all these kinds of things. So nowadays you are listening about the goodwill options, loyalty based options. So these are conditions, vesting condition, based upon which we have to decide that what the employee need to complete when he can claim the shares of the company. Then comes, we have given them the conditions and all. Now what price we will give to the employees? So now it comes a question of valuation. What is the actual value of your company? If you're not aware of your value, how you can offer the shares to your employees that this thing which I am offering to you comprises of this much of value. So requirement of valuation is at the grant stage. You have to compute your value of your company, and then you will offer the shares to your employee, and you can decide only that at what price you want to give, because your price is coming as 100, and if you think I want to give an immediate benefit to my employee, you can offer it at a discount of 10%, 20%, 25%. Even you can offer it at a face value. We cannot go below the face value because there is a legal challenge in India that we cannot offer the shares at a discount. Then it comes, then right has come, price is defined. What is the exercise period? What is the exercise period? Whether the exercise is a time based or it's an event based. Time based, in the listed company, it's very easy to decide on a time factor. But in the unlisted company, there are many challenges, that because employee exercise, then he becomes the shareholder. He will come for the exit. He can demand for the exit also. And when he actually monetize it, there comes that whether we keep the exercise on an event, we will talk on that when the monetization event can be. During the employment, what will be the period? Then post cessation of employment, what approximately I give a time period to my employees to exercise. So these are the questions which we have to settle when we are going for the exercise, deciding the exercise time period for any ESOP scheme. Funding of exercise. Funding means that because many of the companies say ki, from where my employee will take the cash to exercise these options. So this is also one of the challenge in that. So in the listed companies, there are funding organizations which are helping the employees and giving the loan to the employees to subscribe the equity shares of the company. In the unlisted company, now things are coming that the company are funding the exercise by way of creating an ESOP trust. So this is also one of the criteria which we have to think of before giving the ESOPs. Then is come the lock-in. That ESOPs, now the employee has the ESOPs, equity. So there is any restriction that he cannot sell those equity immediately. There is no legal requirement at all. Employee can sell it a very next day. So in the listed company, there is an open stock exchange. He can go and sell those things. And if now the question comes now, if the employer wants, employer can keep the lock-in conditions also. So many companies are keeping, and generally in the unlisted company, so that the employee will not come the very next day and ask the amount. Monetization event, the important one. Up to that, we have gone through that how the employee is getting those shares. Now, how the employee will be realizing those money. So for the listed company, again, there is a very open market, sale on the stock exchange. For the unlisted one, you have to decide that it's an IPO, strategic sale, management buyout, or we have to do for the cash settlement. So these are the monetization event where the employee can settle those ESOPs. Legal concerns for the listed companies. So unlisted companies has the challenge of the exit events. Listed companies has a other kind of practical consideration when they are framing the scheme. They have to abide by the listing compliances. What are the listing compliances? So they have to go for the appointment of merchant banker, in principle approval from the stock exchange, because they are going for the fresh allotment of equity. They have to list that equity on the stock exchange. Otherwise, employee cannot trade with. Disclosures to stock exchange are required at the time of grant, at the time of allotments and all. They have to maintain some, because if they are going by the ESOP trust, then they have to think of that, because ESOP trust is a non-promoter, non-public shareholder in the shareholding of the company. So they are doing with, they have to maintain their minimum public shareholding. So excluding this ESOP trust holding, the employees shall have 25%, the public shareholder should have a minimum 25% holding in the shareholding of the company. Then it's come the PIT. PIT is the insider law compliance. So what is the insider law compliance in that case? So insider law compliance is, it's a pre-clearance. It's a pre-clearance. That means whether the exercise of ESOP is be under the pre-clearance mode, whether the employee, whether this ESOPs are into the contra trade, whether this exercise can be made under the trading window closure. Yes, exercise can be made under the trading window closure. It's a disclosure by the ESOP trust. So what are the disclosures by the ESOP trust and the employees? So these are the insider trading compliances which the employee and the designated, because employees are the designated persons also. So these are the this is the very important law when any employee exercises has to abide by that thing. Another comes is that the attractiveness of ESOPs in the present scenario. So now we have discussed about that we have discussed about that what are the ESOPs, how it can be channelized, what are the practical considerations, and what are the things, what are the various ways, and what are the listing compliances the company has to do. Now, why now the ESOPs are good? So attractiveness of ESOPs in the present scenario. Manage liquidity in the non-monetary compensation, definitely. Today the price are low. Because a great challenge when any company is deciding on the ESOPs is that at what price I am offering to my employee. It's a high price, my employee cannot afford. So today is the price are low. Definitely, if you give today, your employees affordability increases, and definitely in the future when the price ups and goes to their normal position and in a high position, the wealth part is higher in the future years. And definitely it's a cash saving along with the tax benefit. So tax benefit, so you are not the employees. So ESOPs is a cost to the company. Similarly, if you're not paying in the form of an ESOPs, then you are paying in the form of a cash. So you are claiming your tax benefit. So similarly, ESOPs cost is also a tax benefit. So you are saving your cash and still you are claiming your tax benefit. So both things are it's being done. So today it's a good time that you can offer your ESOPs to your employees. It's not only the today's position. Always ESOPs as a continued practice can be used as a very good tool for remunerating your employees. How? For the startups. Definitely new startups come, already startups are there. Startups have many multiple constraints because they have the idea, but they need people, uh, many a times very senior people who can run their businesses along with them. So what they can offer, they cannot afford the salaries of the people because there are many a times the people from the industry are leaving their jobs and are joining the startups. So they cannot compensate them with industry salaries. So what they will do, they can offer them the shares, and they are offering, and so these are the ESOPs. So ESOPs are better way for the startups also. For the listed companies, why? Listed company, if you are giving in ESOPs from your side as ESOPs, so then what will happen? The employee will encash it from the market. So you are giving them the compensation, and the employee at a later date is getting, by selling those shares in the market, can get the realization of that compensation. And definitely it is ESOPs are not a promoter holding. ESOPs will be counted as a public holding. It will also help in the channelizing of the shares and trading of the shares in the market. For financial and IT sector, always ESOPs are a good tool in these sectors, because they are the retention of the employees are a very great challenge in front of the uh, any HR person. So they are remunerating because salaries cannot be compensated, the cash cannot be compensated for everyone, and they need to be motivated toward the company's objective. So the financial and IT sectors are giving a very are using these kinds of ESOPs a tool very much. Now NBFCs also, because in the financial sector, if you go BFSI, all the banks, private banks are offering the ESOPs, and now the microfinance have come up with giving so many ESOPs to their employees. So not only it's a part of an IT, it's a baby of the IT company. The financial sector are using it in a more remunerative way. Now, other than these, the manufacturing and many other companies are also using, and it can be used in the business expansion and research. So if you are you are deploying any new project, when you are deploying any new project, there is a long gestation period. And you want that your employees work toward and your KMP mainly, specifically that they will work for a particular objective, that they will earn 2 3, and then they will be paid off from that earning. So in that case, ESOP serve as a very good tool. Real estate sector ke liye the government is also taking steps and all. So they have also the weak finances, and the infrastructure companies also have a very weak finance and all. So for paying these their expenses, so that can also use the ESOPs. Now research, even the healthcare and bioscience research divisions are using. If you go by the Biocon and all these companies, they have a very good research division, and they are giving ESOPs to their employees. And definitely directly it's a share proportion between the growth and expansion. So ESOPs can be used all time, not only in this time, all time, by all the industries now. So this is the data one of the agency ENY has done. So every sector is now using the ESOPs. We have talked about all these things. So what are the regulatory regimes? Regulatory regimes are that Companies Act are applicable, income tax are applicable, accounting standards are very important when you are doing that. ESOPs, you have to comply with the LODR, you have to comply with the SEBI PIT, and definitely when you are covering your foreign employees. So why the FEMA comes into picture? FEMA comes into picture because now all the companies are multinational. They are operating through various different countries. So it's not that only you are restricted that you have to give the ESOPs to only your Indian companies employee. Sitting in India, as per the Indian Act, you can even offer the ESOPs to your foreign employees also. So foreign employees you can offer, and when you are offering the shares to your foreign employees, subsidiary employees, then you have to comply with the FEMA Act also. So now another important stage in the ESOP comes is that whether if we are giving an ESOP, whether it is going to affect our books. Definitely, as I earlier told you, that ESOP is a compensation cost. When ESOP is a compensation cost, then it has to be recorded in the books, just like any kind of cash compensation. For this, there are the two accounting standards, Ind AS 102 and Guidance Note 18. The cost will be definitely be computed at the time of the grant, and simple, it will be booked over the vesting period. Why it is to be vesting period? Because vesting period is a service period, and this cost you are incurring because employee is giving you something in return and they are serving for that period. So the entire cost need to be booked over a vesting period. There are various disclosures also mentioned in the even the Companies Act and in the accounting standards that you need to disclose in your director's report and in your note to accounts. The last one is that we have given all the things. What is the taxation? Whether it is taxable? So yes, it is taxable. It is the taxable in the hands of the employee. So there are various stages we have gone through in the ESOP. That is the grant, vesting, exercise, allotment, and the sale. So at the grant, no tax. Vesting, no tax with the employee. Yes, when it comes exercise, when employee exercise, that means when he is actually getting the benefit of the ESOPs, then he will be getting the allotment of then he will be getting a tax. What is the tax? It will be counted as a perquisite income. Perquisite income is equal to fair market value on the date of the exercise and the price which he is paying. Now, in the recent budget, there is a relaxation in this for the employees of the startup company. They have made a difference that the employee can, instead of paying the perquisite tax now, employee can definitely defer it till he is exiting from the company, or on a sale of shares, or maximum 5 years he can defer. So these are the tax when he is exercising. Next is the sale of shares. Sale of shares, because once he is exercised, now it's his asset. When he is selling those shares, then the comes is a capital gain. Capital gain, it's a short term or long term. It depends upon the period of the holding of the shares with the employee. And taxation in the hands of a company, definitely is a cost. It is a liable expense in the under section 37. It's not clearly written, but in many of the judgments, IT80 and High Court judgments are there where it has been allowed in all the routes, whether you're going by trust route, normal route, everywhere. Another the companies has to do is, because it's a perquisite tax, it's a salary part, the companies has to deduct the TDS or the perquisites of the employees. So an employee has to pay the tax basis upon his slab where he falls. Once you have done with all your ESOPs, you have framed your scheme, you have covered your employees, you have given the ESOPs to your employees. Now the challenge comes how you will manage all these things. So definitely you require a tool. You can have a various tools, and we have an also tool for the ESOP by the name of the ESOP Guardian, through which you can manage your ESOPs. That means entire process. Once you have framed the scheme, rest of all you can leave on this tool. All the vesting and the process get automized. You have various reminders. It can be accessible to the employees 24/7. They have various MIS. Employee need not to approach HR every time or a secretarial team key. What is the value of mine? He can see in their login all the details of the ESOPs granted to them. So through tool, it will ease you out in managing all this ESOPs in the future. Okay. So thank you everyone. So I over to the Chandar for giving you a, because ESOPs is you can say adhura hai without valuation, because if it's not value you require when you are giving a grant to your employees, value you require when the employee has to exercise those options. So at both the time ESOPs valuations are very important. So Chandar will give you an insight on how the valuations are being done under the ESOPs. Yeah, over to Chandar.
Thank you, Mohini. So you have given a very detailed and comprehensive discussions on Esop. What I'm going to cover about the valuation aspects of Esop. So 4 or 5 things which I have covered in my brief presentation is: one, the stages in Esop implementation, which largely is covered; Esop valuation, guidance under AICPA practice guide, which is an international guide which we can take inference from while we do the valuation of employee stock options, consideration in option pricing models, and some question and answers. So if I just give you a stage, see, there are 3 broad aspects in any ESOP implementation. First is a commercial, second is legal, and third is financial. So, we start from a grant date and then we move to vesting, then the ESOPs are exercised and later on they are sold. So now valuation, when it comes, we need to understand what is the point of valuation. So first of all, valuation is done at each grant date. When we are talking of equity settled employee stock options, then valuation is to be done at each grant date. And then second valuation requirement comes when after the vesting period, those employee stock options are exercised. So at that times, there is a tax liability, perquisite tax is determined, for which a merchant banker has to value. At the third time, when the employee stock options, in fact, the shares are given, and then when the shares are sold, at that point of time, the third valuation is to be determined. Now, if you look at the respective financial section, then under accounting, there is a Companies Act requirement and there is SEBI requirement. Under perquisite income tax, there is income tax section 17(2)(6), which is applicable, and there is CBDT notification number 94 of 2009. And when we calculate the capital gains, we need to derive the cost of acquisition of the ESOPs. Then section 45 and section 49(2)AA comes into force. So very, very important. First of all, we need to understand that options gives the rights and they are not the obligation. When we do valuation, then valuation is not of the option, valuation is of the underlying instrument. An underlying instrument can be an equity share. Options are broadly of 2 types. Options can be European options or options can be American options. And American and European options difference is determined based upon their expiry date. So if an option is exercisable at a point of time, say the option is after 5 years from vesting, then that is an European option. And if an option is that it can be exercised at any point of time, then that is an American option. Now, the difference between European and American is that in terms of valuation, when we apply the option pricing models, then option pricing models, European options are generally valued using Black-Scholes model, and American options are generally valued using binomial models. So I'll take it up later on. And again, ESOP options can be call options and put options. When we talk of ESOPs, then ESOPs are the call options because there is an underlying right to buy the shares at a predetermined date and on the basis of predetermined scenario of price. Either the price is certain or it is linked with market forces. So ESOPs are call options, which we need to understand. Mohini had mentioned before that Ind AS 102 is on employee compensation, and ICI guidance note, which came back in 2005. Both of them give guidance on accounting and valuation aspect of ESOP. But more specifically, we follow Ind AS 102 now because which is a detailed guidance, and a lot of aspects are covered on how do you need to value employee stock options. So see, there are two broader aspects we need to understand. One is an accounting compensation cost, and second is a tax on valuation. These two are the trigger event for valuation. When we take up the accounting compensation cost, there is an intrinsic value and there is a fair value. Intrinsic value is the normal equity value of any company. So like we follow income approach, market approach, asset approach, we derive a value. That value is called as intrinsic value. Suppose the value is 100 rupees and the Esop have been exercised at 50 rupees. So 50 rupees is the difference, which is a compensation cost for one option that needs to be apportioned over the vesting period. When it comes to fair value, then fair value is on the top of intrinsic value. So for fair value, whatever we have done for intrinsic value, we need to do that again. After that, we need to apply an option pricing model. And there are two practical option pricing models, which is one Black-Scholes and second is binomial model. There is also another option pricing model, which is Monte Carlo, but generally Monte Carlo is not applied in practice because Monte Carlo is actually a performance driven model. So that is not the condition which we see in practice. Very important thing, I was noting a lot of questions have come already, that if we have granted an Esop and the Esop is equity settled, then whether there is a need of doing valuation at the time of vesting also, at the time of exercise also. The answer to that is that for the point of view of accounting valuation, the valuation is to be done only at the date of grant for equity settled. The same needs to be apportioned over vesting period. Cash settled Esop is to be measured at each reporting date. So if you are getting equity, you value only on the grant date. If you are getting cash, then you need to value at each reporting date. Let's come to the second part of Esop valuation, which is perquisite valuation. So when we do a grant, then after grant, there is a vesting period. And we need to make sure that regulatory aspect is very important in this, because again, some questions are there. Under the Companies Act, there needs to be a minimum period of 1 year from the grant date to the vesting date. So 1 year vesting period is mandatory. It can be 2 years, it can be 3 years. So again, after the vesting period, there comes to be exercise. At the date of exercise, we need to look at whether my company is a listed company on a recognized stock exchange in India, or my company is an unlisted company. If the company is listed at recognized stock exchange in India, then we have to take the opening and closing market price, and the average is the value. There is no need for taking a separate valuation. In fact, very important point I would like to mention, there is no segregation between an infrequently traded or a frequently traded company. Whatever is the trading volume of the company, if it is listed, even if it is not traded on the date of exercise, you can take the last closing price. This is as per the income tax stipulations. May not be correct, but law of the land is this, we need to follow. When it comes to unlisted company, then unlisted company, mandatorily you need to appoint a merchant banker, and valuation has to be done by a SEBI registered category 1 merchant banker. Herein it is important to note that if you are issuing the RSU or ESOP of foreign listed companies, so if a company is listed at NYSE or NASDAQ or DO or any other stock exchange outside India, those stock exchanges do not constitute recognized stock exchange. So merchant banker needs to be mandatorily appointed, and a valuation needs to be determined by the merchant banker. Merchant banker may or may not consider the prevailing market price, which is there on the recognized stock exchanges, and a valuation report would be mandatorily required. Again, when we come to an intrinsic value, the valuation approaches do not change. There is an income approach, asset approach, and market approach. So you can do a comparable trading multiples, you can do a discounted cash flow, you can do a book value method to arrive at an intrinsic value. Very important aspect I would like to touch upon. See, AICPA guide is see, when we talk of valuations, actually in India, we do not see much of literature on valuation. So whenever you need to study or whenever you need to take inference, you must refer to the US concepts, because US is actually very detailed in their valuation processes. And one of these practice guide on ESOP compensation, they came out in 2013. And what they say very, very clearly, that if you look into the underlying portion, then the valuation for ESOP is of a minority non-marketable interest. So very important that I always say that purpose of valuation is very important. And here the purpose is ESOP, and ESOP is leading into a minority non-marketable interest, right? Fair value principles needs to be followed, and fair value is clearly defined as an orderly transaction between market participants on the measurement date under the current market conditions. The take home very important here is that ESOP valuation is minority valuation, non-marketable valuation. Why I'm saying so? Because suppose you apply a discounted cash flow model. A discounted cash flow model typically gives you a controlling valuation. Here we need to arrive at a minority valuation. So what you have to do, you have to apply the discount for lack of control in order to arrive at an employee stock option. So there can very well be difference in a controlling stake valuation and a minority stake valuation. Similarly, it again gives guidance that we can apply income approach, market approach, and asset approach. And again, if you look into ESOPs, generally ESOPs are issued by startups. We have done a lot of valuation of startups. If you look into their balance sheet, their cap table, then you will find series A, series B, series C, series H, I, J, right? And all the series of the instruments are having differential rights. So it is not that if the series A is issued at 400 rupees, it can have certain liquidation preferences which other series may or may not have. So here the concept is called as a waterfall methodology or a backsolve model, wherein suppose a series J instrument is issued at 1000 rupees, and now you need to derive the value of employee stock option, and you need to derive the common equity value. So what you can do, you can take that valuation of recent investment round, and from that recent investment round you can apply a waterfall methodology and apply and give attribution of the valuation to all the prior rounds, including the common stock and employee stock options. So this is not a technical session, I just wanted to touch about it, that there is a backsolve model which is available, which can tell you that if right now my share is getting traded at X amount, then what are the prior series worth? What is the common stock worth? What is the employee stock option worth? And again, like I mentioned, in practice, what we do, we apply more of comparable trading multiples approach because it's a minority valuation method. We do consider book value. We also apply discounted cash flow method, but discounted cash flow method can come with its own discounts. And mind it, when you value employee stock option, being a minority stake, there can be a lot of restrictions. Like recently, I can recall there was one case wherein there was a blackout period. The employees were not allowed to sell it for a period of 5 years. Certainly the valuation will change. The discounts have to be built in. There can be a lot of restrictions in the agreements. So do ask for a copy of grant letter, and do ask for a copy of employee scheme, Esop scheme, for understanding the nitty-gritties of terms, because Esop can have different vesting schedules for different level of employees. This is also another question. So it is not that you do valuation, if the vesting schedules are different, then you need to apply fresh valuations. If the grant date is different, you need to apply fresh valuations. And generally, if you have done the valuation on the date of grant and nothing changes, then you don't need to do any valuation again. However, if there is a modification in the scheme of Esop, say the pricing changes, the price becomes unfavorable in the present market conditions, maybe a company might have issued at a price of 200, and today the price is running at 100 rupees. So nobody would like to exercise that option. In that case, you can reprice, and we have seen repricing happening in this period of time. And at the time of repricing and modification, there is a requirement of valuation prior to the modification, and after the modification to determine that what is the differential compensation cost which is going to be booked in the P&L account. One important aspect that I would like to touch upon is that what do you do exactly in option pricing model? I mean, we discussed about a general valuation, intrinsic value, but you know what we do in option pricing model? There are certain additional factors which are considered in a option pricing model, and essentially there are 6 factors which are considered. One is the exercise price of the option, which naturally the company tells us that this is the exercise price. There is a life of the option. What we do in life of option, there is a minimum life of the option and there is a maximum life of the option. So in practice, we take the average life of the option here. There is a current price of the underlying share, which again, current price is the intrinsic value, which you need to work out. Expected volatility of share prices. I mean, we have been seeing, just look at the markets right now, the volatility can be as good as 50%. So volatility is an important ingredient. The more the period, the more the volatility, the more will be the value. Dividend expected on the shares. If you are giving the dividends, then the value is getting reduced. Risk-free rate of interest. So we take a long-term 10-year rate of interest, and I just created a slide for the benefit of everyone that if we look into these variables, if the variables changes, then what is the ultimate change in the option value? So if the exercise price change, because it's a call option, remember, call option is the option to buy. So if the exercise price increases, the value reduces, market price increases, the value increases, dividend yield increases, the value reduces, and other 3 components, the risk-free rate of return, expected option life, and volatility of the stock, if they increase, the value increases. So ultimately, there is a normal intrinsic value and there is a Black-Scholes and binomial model. I am not touching about the binomial model because that is going to take a session in itself, and that's a very detailed process. But by and large, the option pricing model, when we say Black-Scholes, is practically implemented in 9 out of 10 cases when it comes to the requirement of option pricing model. So this is what I have broadly touched upon, and now I would request Mr. Madhav to take up and share his experience, please. We can take up the questions later on.
Okay, thank you, Chandar. Now we will Mr. Madhav will from Aditya Birla Group will share his thought and how he is using the equity compensation in Aditya Birla Group and share his practical tips to us. Over to Madhav.
Thank you, Pavanji. Good evening, everybody. Pleasure to be with all of you and speak to all of you. I'll just give you a perspective of the Aditya Birla Group and our journey of using the long-term incentives or equity compensation over the last 15 plus years or so. In terms of the context of the group, we are a conglomerate, the Aditya Birla Group, with businesses in cement, metals, textiles, telecom, financial services. So there are various business lines that we work with, and our aim is to be a significant player in each of the businesses we operate in. Our businesses, most of our manufacturing businesses are spread across India and globally. So in metals, we've got the Hindalco business. We would have Novelis in the US and various other countries. Our services businesses are more focused on the India market. The group has grown tremendously over a period of time, and this is just kind of a perspective of where we were in 1995 and where we are today. The group, in terms of its even the employee profile, is changing. We're getting younger as a group in terms of the age profiles. Our revenues have gone up many-fold, and even our geographic presence and our manufacturing facilities. Challenge is that, how are you looking at the overall reward perspective for the entire group, both from a India perspective and globally when you're looking at managing rewards across different markets that the group operates in. Just a snapshot of our global presence. In terms of as we are all, this is a time where we are faced with the situation that some of us will be faced with excess staff. We are not able to work and produce, but definitely people are our most important asset. And in terms of our value proposition for our people, it is a world for global opportunities for professional growth, and our employee value proposition centers around opportunities for people to build fulfilling career aspirations, the opportunity for them to learn and develop, they to be recognized, and we'll come to the various reward tools that are part and be available to be recognized for the good work the employees are putting in, and to enrich their life and a healthy, balanced life. So all of these kind of make up the entire value proposition, which encourage our employees to come and join us and contribute to the group, its success and its growth. My screen is back now. I'm just sharing with you a snapshot of our reward philosophy, where the compensation is designed to attract, retain, and reward talented employees. The program is a balance of both monetary and non-monetary remuneration. The overall program defines pay for performance. So our pay plans incentivize our people to perform in line with the business strategy and get rewarded once the performance is in place. And if there is, on the performance side, the variability comes in on the pay for performance aspect. So that's the piece on emphasis on pay for performance. We benchmark the compensation to industries and geographies. So there would be the financial services would pay akin to what would happen in financial services. The metals would pay what metals is paying. Metals India would pay akin to what the industry is paying in India in the metal sector. If you're looking at global companies based in the US or Europe, then we would take the consideration of what the respective market of where our employees are. That is taken into consideration to decide what should be the entire compensation. When we are looking at compensation, there has to be an appropriate mix of compensation. So there are various heads of compensation that we look at, and we had a beautiful presentation here talking about the equity part of the compensation, where in order to motivate and retain our employees, there has to be an appropriate mix, and that mix again varies by the industry sector and the geographies in which our businesses operate. It also varies by the level of the employees. So you would look at top management, the mix is different, senior management, middle management, and so that needs to be taken into consideration as you're deciding. So we have a mix of fixed compensation, the annual incentive plans, or for our sales staff, pre-sales incentives and production incentives for production teams. Long-term incentives is akin to the Esops or other plans where the performance is measured over a period of time, maybe 3 years or 4 years, where we are setting targets and looking for employees to go for those targets over a longer time period. Then there are, of course, the perks and benefits. So that's overall in terms of that. As you're looking to work through onto the ESOPs, how does it kind of fit into the overall scheme of your comp philosophy is an important thing to consider. Specifically zeroing in on the ESOP, why do we do ESOPs, or why do we look at long-term incentive plans? Their piece is that you set in place goals to say that this is where your business is today, and you would want to reach at a certain level over the long term, and to incentivize stretch performance. There has to be a balance between fixed and variable compensation, and there has to be a measurable difference where the teams that have been working have delivered a great performance. They see a significant upside in their overall actual compensation because of the pay at risk. And if things are not that well, then what will be kind of left off is only fixed compensation, and variable would then kind of fall off if things are not falling in place from a performance standpoint. And there has to be an element of retention over the long term, so people look forward to staying with you over the long term to be able to see the gains. So that's largely the objectives. Just to add, in the current context, it also helps, you have a pay mix, that the fixed compensation is something that sustains the individuals and our employees over the period of time, and the variable compensation is something that helps, even, we are facing the situation today where a lot of the businesses are not able to operate. The variable compensation can be curtailed or lower. So the employees also understand that fixed compensation is something that is going to come to them month to month, and the variable compensation helps to balance off when the situation is not expected. It's an extraordinary situation, but it kind of comes in handy in a time like this. As we are a conglomerate, and we can also move people across, mobility is something that's important. So that we take into account where we are working through our long-term incentives, that their people are not just tied down to one industry and are able to move across different industries. We largely started our experiments with long-term incentives early on in 2005, 2006, where we gave, mainly to our listed companies for leadership. There was Esops. That was only one vehicle where it was employee stock option plan. There was a grant price, and then the grant price equal to the price as on the date of grant, and then that vested over a 4-year period. We then moved to our second wave, where we looked at the next phase of growth, and the vehicles there were Esops and RSUs, largely saying that we would be looking at employee stock options. 75% of the overall grant will be an employee stock option plan, and 25% will be a restricted stock unit. Restricted stock unit, we are giving our grants at the face value of 10 rupees. As we covered earlier in the presentation, that there is a regulation where there is a minimum value. We can't go below the face value. And we made these grants in blocks. So, we gave a grant and we didn't give any other grants for the next 4 years. All the grants were bunched together at a point in time, which was a vesting period of 4 years. And then we moved to the next phase where we are currently operating today, where we move to more frequent grants, where we make grants every 2 years. The coverage is again sector specific, probably in the financial services or in the apparel sector, the grants would be deeper. It will go down to middle management level. For manufacturing, it will be more top end management. So the quantum of grants would be very different in the West. What the pay mixes are significantly more heavily weighted towards variable pay in the US market, and less so in Europe, and then less still in India. So all of that takes into consideration when these grants are made as we go forward. We've also enabled a trust option where some of our listed companies were using the trust to make the grants instead of issuing new shares when the options are exercised by the employees. So in terms of as we look at making the grants, there are different models. There is a model for manufacturing, there is a model for services where the industry is different. Financial services, again, as we were covering, that's an industry that's quite competitive, and this is a very prevalent instrument of reward, and the pay mix of financial services is very different compared to what you would look at manufacturing. So that's another model, and then is the area where when we are doing any startups, then that model where we are not talking about any listed company. This is just a company that's been set up and is expected to generate value over a longer time period. There is valuations that are involved as to how, and the projections in terms of where we're looking to take the business over the next 5 years. So that model is different. So those are different models that we look at while the design of our LT plans. Here, as we're looking at different businesses in the West, the grants are in some businesses looked at on an annual basis. So every year grants are made. Biennial is once every 2 years, and we have just migrated from a model where we used to make grants once every 4 years. There are different instruments that we look at, which again, Moini also covered earlier, where there are stock options and RSUs, there is phantom RSUs. We also look at some cash plans with key matrices, internal matrices, or relative matrices as to how the business is doing versus external comparator group, and a combination of stock and cash plans. On the grant, how do you determine how the number to be determined, or how do you, there is an intrinsic value in terms of saying that where are you seeing business expected to grow over the next many years, and do valuation basis that, or you look at option pricing, or the flag shows value we just learned, and a percentage
Okay.
For our startups.
Okay, Madhav, nicely done this. Now we will start question answer.
That's largely what I had to cover.
I think Vivek.
I hand over back to Pavanji to kind of take us through the questions.
Okay. So thank you, Madhav. Thank you very much. Now it's a time of question answer. Friends, we have received more than 150 questions. So what I'll ask the question because all questions have come for Madhav, Chandar, and Mohini, all three valuation and other aspects. So there is a rule for this question answer. You have to be very precise and not to explain because questions are more and multiple things are there. I will avoid the duplicacy of the questions, but you given some questions which I have prepared for all of you for the benefit of the public. I'll ask you. So first question, Madhav, I'll start with you. You have your company which has listed company, unlisted company, and startup. So how and model you follow for all these companies? So what is your approach to follow this? Madhav, I think there is some technical problem from your side. In the meantime, it is okay. I will ask questions from. I'll ask questions. Okay. Only I'm asking a question. If the Esop scheme is implemented and few options are granted and exercised till date, can we still amend the scheme in future to apply the Rule 12 of companies shares and capital debenture rules? Only your voice. You are mute.
Oh, sorry, sir. So, sir, if the scheme is in the implementation stage and the company is already granted and few of the options have been exercised, so you cannot per se change the type of the option scheme. You can close that scheme and can start with a new scheme.
Okay, Chandar, at what point the time company shall do valuation?
So valuation is to be done for Esop on the date of grant for accounting purpose and on the date of exercise for tax perquisite purpose.
Okay, we aim to grant stock option on quarterly basis. Whether valuation shall be done at each grant or it can be done on yearly basis only.
Each grant.
Okay, suppose we grant option today and vesting comes in 4 years in graded manner. Do I need to do valuation at every year?
So valuation, this is same question coming again and again. Valuation is to be done on the date of grant for equity settled schemes.
Okay, not every year. Okay.
Not every year.
Sir, I want to add. I want to add. Yeah, definitely vesting is done, but exercise on every exercise.
Exercise is different aspect. We are talking of
exercise.
Exercise is different on each grant and on each exercise. You need to value.
Only if the company having employee who are foreigners has implemented an ESOP scheme through trust route, how trust can provide benefit to such employee? Whether direct transfer of shares in their demat account can be done, or shares need to be sold in Indian market and only money can be remitted to those employees.
Both ways, sir. Both ways you can do. If the employee can open the demat account, you can transfer the shares in the demat account based upon the FEMA regulations ki kitna FDI mein, because it falls. And if it is not, then you, without opening demat account and PAN, you can transfer the final amount to the employee's account also.
Okay. Now the pool of ESOP. Suppose a company has both equity and preference shares in their paid up capital. The company wants to make ESOP of 5%. This 5% would be equity capital only or preference capital only or both?
If it's giving from the equity, then the equity will be taken into account.
Can I give preference shares also as the ESOP?
You can, different kind of class of shares you can give. Then the value of the preference shares will be taken into account when we are going for that.
Okay, there is a interesting question on merger. Suppose company A and company B is there. One of the employee of the company A has resigned, but his vested rights are still in place and he can exercise within 2 years. Now company A is getting merged with company B. Can company B grant option to that employee who ceased to be an employee of the company A, as his vested rights are still pending, but he is not a permanent employment of the company anymore?
No, he cannot, because grant first condition he should be in the permanent employment of a company. Vested rights se kuch nahi hai. He should be on the payroll of the company at the time of grant.
Okay, another question: whether we can offer differential price of the ESOP to be granted in the same scheme?
Yeah, ESOPs are freely priceable. Even in the, you can have a differential pricing for different kinds of grants.
So I have a senior employee, a junior employee. I can have a both different price for both.
You can do. There is no legal restriction at all.
Chandar, how valuation of shares foreign companies done under RSU, restricted share scheme? Is it a mandatory? Pardon?
Yeah. Please continue.
How valuation for shares of foreign companies done under RSU scheme? Is it mandatory to be done whether such scheme are listed on foreign stock exchange?
So if a foreign stock exchange company is giving the ESOPs of foreign company, then they need to take mandatory valuation from a merchant banker. They are not exempted. They are not considered. A foreign stock exchange is not a recognized stock exchange in India. So yes, a valuation is mandatory.
Okay, Madhav, are you able to connect now?
Yes, can you hear me?
Yeah. Madhav, now the question for you: your company has a multiple companies, listed company, unlisted company, and startup. So how you are valuing, which type of ESOP you are giving on all these three companies?
Sure. So in terms of our listed companies, we are using the listed company stock. So companies like Hindalco or Ultratech or Grasim, we would use the listed company stock. There would be unlisted companies, which are probably subsidiaries of our listed companies. If say Novelis in the US, we would use stock appreciation rights, a combination of stock appreciation rights, and if required, even for unlisted companies, a combination of a listed company stock in the form of SARs, or a cash plan where some internal metrics are there over a performance period, and then the payout is based on the performance on that. In case of startups, we would use the stock, but those stocks are not listed. We would use it as a percentage of equity capital. We will then give it to the startup team, and then over a period as the performance goes, the employees gain from the grant.
Okay, which type of ESOP scheme is popular in your company? RSU, SAR, and Phantom. Which type of or ESOP?
In terms of, we are using two instruments largely for our listed companies, which is the employee stock options, where 75% of the grant is based on the employee stock option, and keeping the retention objective in mind, 25% is based on RSUs. And depending on the different business, we do different variations of that, but largely for our listed companies, that's the scheme.
Okay, Mohini, can a listed company issue shares through ESOP to an employee of a step down subsidy, which is a foreign company?
Yeah, in as per the legal, as per the law of the India, you can offer the ESOPs to your subsidiary, whether it's in India or outside India. Both are covered.
Okay, now in case of stock appreciation is right, SAR, is it necessary to decide upfront whether it will be a cash settled or equity settled, or cash it to be decided at a later stage?
No, it is to be settled upfront. And in the listed company, you have to settle it at the before going for the board approval also.
Okay, can we keep differential vesting period for different category of employee under the same scheme?
Differential?
Can we keep differential vesting period for different category of employees under the same scheme?
Yes, we can do, because it's up to the management. You have to define your minimum and the maximum vesting period, and in between that you can keep different vesting for the different categories of employees and at the different time of grants also.
Madhav, you have this type of things that different scheme, same scheme has a different types of things for different employees.
So in terms of employees, if the scheme is different, so if you are giving some grants to junior management at for talent, etc., then the vesting period is shorter, and the instrument is RSUs. In terms of instruments, as I was explaining, that the ESOP instrument is a vesting over 4-year period with a 25% vesting, and the RSUs vest 100% at the end of 3 years. So we differentiate it at the instrument level.
Okay.
Not so much at the employee level, but that's possible. Yeah.
Okay, Chandar, whether valuation of ESOP should be done by registered valuer or CA or merchant banker?
So for accounting purpose, there is no requirement of who has to do valuation, because it is of the comfort of the auditors. Anyone can do technically. In terms of the tax purpose, it is mandatory to be done by a merchant banker.
Okay, Mohini, if a company issue ESOP at face value of say 1 rupee, and then company issue bonus share at the ratio of 1:1, how will the adjustment made to outstanding options? Will be price be adjusted to be say half per share, which will be below face value and is disallowed as per the Companies Act, or will it be bonus stock option and the price will be made free or a zero cost?
In case of a bonus issue, when your face value is a minimum face, your exercise price is a face value, definitely the new shares cannot be issued below that value. So for those shares, for the employee, it's a free, and ultimately, as you are giving the benefit to the other shareholder from the reserves of yours, so that you have to take from the reserves and you have to offer them against those shares which are being exercised for the bonus adjustment by the employees.
Okay, what is the difference between ESOP and sweat equity? Which is preferred?
Both serve different purposes. So in the ESOP, there's a long-term retention plan, and definitely equity when you are offering any ESOPs to any employee. So it's an option today. It's not an equity per se. So you're not parting with your equity today only. When you are going for the sweat equity is the per se equity issuance today only. And it is not to be issued at a large scale for all the employees. And it is also not dependent, sweat equity is also not dependent on the fulfillment of few conditions, as you can do in your ESOPs. So the sweat equity can be given to the employees based upon their knowledge or any kind of know-how they are bringing to the company. So for those employees, it's good, but they again go for the 3 years lock-in, and employee cannot even it basically it's not a per se a retention plan. It's for the sweat he is giving to the company. You are offering those sweat equity shares to them.
Okay, now because we have exceeding time, so now it's a rapid round. So please give answer yes and no, and explain a little bit. Madhav, you have given sweat equity in your company to any of your employee?
We briefly used it in a startup, but that's a cash plan.
Okay. Mohini, if ESOP are issued at a discount to market price, or even when it market price and valued at a fair cost, with the non-cash compensation cost allowed as a tax deductible expenditure?
Yeah, it's allowed as a tax deductible expenditure.
Okay. ESOP can be given to permanent employee. What is meant by permanent employee? Can be a contractual employee, or the professional working in the company on a retainer basis can be permanent employee?
No, retainers, consultants, and the people who are on the probation period, they are not covered under the this permanent employee definition.
Okay, lock-in of the ESOP vested shares mandatory for all companies, including unlisted companies?
Yeah, minimum 1 year vesting you need to give, whether it's enlisted or it's an unlisted company.
Okay, pricing. Should the exercise price be predetermined even for a private company?
Yeah, at the time of grant, you have to decide that at what price employee will exercise at a future date.
Okay, if so, is there any particular method to calculate exercise price, or any price can be kept?
Any price you can keep from the fair market value till your face value. In between, you can fix any price. It depends upon the benefit you want to give to your employees.
Okay, what is the difference between graded vesting and ungraded vesting?
Graded means it's spread over a years. For example, generally in today's scenario, the companies are giving 3 years period of vesting. So it's a graded vesting. That means today 25, for example, it's a 4 year, 25, 25, 25 every year. So it's a graded. Ungraded means 100% at the end of a specified period. For example, after 2 years, if you remain in the organization, I will give you 100% vesting. So it's not graded. It's a one-time vesting.
Okay, when ESOP become a perquisite, is it the time to exercise or a time when the allotment is made?
Exercise.
Exercise.
When the actually exercises, when he actually gets those benefits.
Can we prepare ESOP scheme for one employee only in which 10% of the shares of the company is to be given?
In the up to 10% definitely you give, because beyond 10% you cannot give because there is a legal restriction on it. But definitely you can frame a scheme for one employee also. Generally, company go for these kind of things for the KMPs. Generally, the CMD. If you go, example is the Capital First, which is now an IDFC First Bank. They have framed a scheme for the CMD, exclusively for CMD.
Madhav, have you designed a scheme for only one employee in the company? Any startup and other people?
We have for a startup, we have done that.
Okay. You have a trust model or you have a general model for the scheme?
We have both, and for a few of our companies, we've recently done the trust model about a couple of years back.
Okay, so you have a internal trust, trustees are internal employee, or you have a professional trustees?
The trustees are internal employees from the group.
Okay, different kind of option in one scheme. Can all different types of stock option, RSU, ESPS, and ESOP be implemented in one scheme, Mohini?
Yes, you can do ESOP, ESPS, but you have to categorize out of the pool. Ki a total pool in the scheme, how much is for reserved for the RSU, how much you can reserve for the ESPP and for the ESOPs. And in the
Okay.
listed company, you have to take the separate approvals from the exchange for all these things.
Okay. In case ESOP is through trust route, do the shares need to be kept with the trust from the time of granted only?
No, not necessary.
Okay. Can we have clause?
You can define your period. You can define your own period, because before exercise, the main thing is when employee is exercising, trust be able to honor that exercise. So before exercise, starting of the exercise period, trust should have the shares.
Okay. Can we have clause on ESOP plan that vested grant will expire on termination of employee on death?
No, the law says that in case of a death, all the options granted to the employee get vested on the date of the death, and the legal heirs has a complete right to claim those shares.
Okay. Madhav, have you undergone this type of some ticklish issue where the employee died and the entire thing you have to give to the legal heir, and there's some issues in this? Okay. Chandar, what is the difference in valuation for equity settled and cash settled ESOP?
So the difference is basically that I mean, in terms of valuation, nothing changes, but when you do grant of on the date of grant, you need to value both, but cash settled is to be valued on each reporting date as well.
Okay, Mohini, is MGT 14 required to be filed when the ESOP scheme is approved by the board of the company or when shareholder approval is received?
Board, at the time of board also, and shareholder, both.
Okay, when face market value is less than the face value, suppose face market value of company is less than the face value, say 10, is still exercise price need to be 10, or it cannot be less than the face value, or in case we can have the exercise price below the face value?
No, you have to keep minimum as the face value, because discounting is not allowed. As per the company said, we cannot issue the shares at a discount in this case.
Okay, what is the difference between ESOP and RSU? As the ESOP also we can have vesting condition which is tenure based or performance based.
RSUs, definitely in the ESOPs you can also have the same terms of condition, but RSUs gives a good strengthen to those conditions. So that why RSUs are preferred if you are going for if you want an employee to complete that particular condition, that suffice that condition, and will get the shares. So RSUs in that case are good.
Okay, Madhav.
So Madhav can add in this, because Madhav has the ESOPs and RSUs both in this company.
Yeah, Madhav, you have any point on this? Madhav, your voice is not clear. Otherwise, your voice is not clear.
So on
Yeah, yes. Okay.
On ESOPs and RSUs, the question was whether you can have in both kind of performance conditions, retention and or performance conditions. So both conditions are possible on both these.
Okay.
Can you hear me now?
Okay. Yeah. Moini, what is the difference between stock appreciation right and phantom stock unit?
Phantom is also SAR, stock appreciation. If the stock appreciation is being settled in the form of a cash, then it becomes a phantom stock.
Okay, what is the benefit of the company exclusively derived from trust route, which are not available under direct route?
This is the for listed and unlisted, the benefits are different. For the listed stock, if you have a trust, even from the secondary acquisition, that means from the market, you can channelize those shares and give to your employees without further dilution in the promoter holding. If you go for the unlisted companies, trust helps to retain the shares on behalf of the employee. Even if the employee leaves the organization, trust will hold the shares, and whenever exit event comes, trust will transfer those shares to the acquirer and will transfer the cash to the employees. So in the unlisted companies, trust helps in that.
Very short answer you have to give. Very rapid round is going because we have so many questions, so we have to finish fast.
Right.
Can interest-free loan can be given to granted to trust by company if approved by way of special resolution of shareholder is taken under section 67 of Companies Act, or company need to comply with section 186 of Companies Act?
Section 67 is sufficient. Yeah, Madhav can add. Yeah, Madhav?
Yeah, I said the interest-free loan is possible. You don't need to definitely have the interest. If there's a special resolution by the shareholders, that can happen.
Yeah,
Okay.
Section 67 is only to be complied.
Okay, Moini, is the company need to pass a board resolution when the ESOP option lapses or cancel the options?
For lapse, no, but if you are cancelling, NRC resolution is important.
Okay, Madhav, what types of ESOP will you recommend today when the COVID era is there and the people are not paying the salary or they want to compensate salary by this? So which type of model you will prefer?
So here, basically the employee ESOP can be used where we are looking at the leadership team, which is going to take us out from the current situation to a point of future growth. So in terms of the things to be taken into consideration is that you could grant it either if you're looking at ESOPs, the stock price are lower right now, and they expect it to grow in the future as we come out of the situation. So that's an important consideration, and the quantum can be looked at that there is no completely willful gain. So whether you want to grant it at the current market price or an average price of the last 2 to 3 months, those are some considerations to be kept in mind as you make the grant.
Okay, Chandar, if option are exercised over a number of years, say 25% each year over next 4 years, in order to determine taxable value of purchases, does the company need to do valuation each year?
So we would have to look at the exercise date, and if the exercise date linked valuation can be done, a valuation which you do for exercise purpose is valid for 6 months. So whatever comes within 6 months, you can accumulate and then do again.
Okay, Moini, can a private company issue ESOP to a person who is the employee but is also shareholder of the company?
Employee and shareholder, yes, you can.
Okay.
You can do.
Can I give ESOP to my independent director?
No.
Okay. Can I give? Okay. Now, is there any way to company to take back the shares exercise option at the time of exit of the employee from the company?
Company, if want to take, then he has to go for the buyback of shares. All formalities need to be done. Otherwise, promoters can take the shares from the employee if he's exiting.
Have you seen something? Some employees are leaving and then you are taking back shares from them?
So in terms of in the listed companies, so that's not happening. When the employee is exiting, if the person has already exercised those shares, the shares are with the individual. In case of private companies, is a piece again you have to do it with employee consent and buy it back from them if they've already exercised it.
Okay, Chandar, if vesting is same 3 years, why the risk-free rate for a long term of 10 years? Why not risk-free for 3 years?
No, it will be basis the period of grant itself. So it's not 10 years. If it is 3, it's 3. If it's 5, it's 5.
Okay. Is there any definition for minority non-marketable interest?
No definition as such, but you need to understand that, I mean, if a person is given 0.5%, it is a minority, you cannot sell, so it is non-marketable. So no definition as such, but Esop is covers.
Okay, Moini, director holding more than 10% of capital is not covered under Esop. There is a circular from DPIIT that the eligible startup can allot Esop to promoter for up to 10 years from date of incorporation. What is the answer for this?
Yeah, it's correct. Law has the government to promote the startups and the founders because they are paying the good sufficient time to the company. So the startups can issue the ESOPs to the promoters also.
What is the cost to be booked? It is the time of grant or actual or accrual in books at the time of vesting.
At the time, the cost value to be determined at the time of grant, but it to be booked over a vesting period.
Vesting.
Okay. Should variable compensation of ESOP from part of CTC of an employee?
Yeah, because now the ESOPs are being offered as a part of offer letter only, so the companies are using it as a part of a CTC only.
Okay.
Over
Part
and
of the
above
total
both
compensation.
total compensation.
Can a company buy back its option without option being exercised by the option holder?
Not clear.
Only with the
Please repeat.
consent of the
Okay. Consent of the employee.
Right.
there has to be a consent. Once the contract, you've given the option, you can take it back only with employee consent.
Okay, Madhav, in ABG group, are there any listed company in which ESOP are given?
Yeah, over a period of last few years, yes, there have been unlisted companies where we've given ESOPs.
Okay. Particular year, more than 1% of equity can be vested to a single employee. Can you throw some light on the aspect of these limits?
Yeah, more than 1% in a single year you cannot give. You can give, subject to the shareholders' approval. So you have to clearly specify the name of that person to whom you are giving.
If ESOP scheme is through trust route, in principle approval is required, both in fresh allotment and secondary allotment.
In fresh allotment, yes. In secondary allotment, no, because there is no fresh equity issuance.
Okay. Can a company create a new scheme for a specific employee when the old scheme is still in operation?
Yes, it can.
Yes, you can. Yes,
Okay.
can.
Can we offer differential voting right as an ESOP in unlisted company?
Yeah, if you are fulfilling the terms of your differential voting right as per the Companies Act, you can use, because companies go for least possible voting rights for the employee.
Voting right shares to your employee?
We don't have a differential voting piece. We have regular grants.
Okay. Can ESOP scheme includes future employee also or present employee only?
Present employees only.
At the present employee, but in the same scheme we can offer it to. It's for the longer term period. So any new employee joins, we can offer them under the same scheme. It's
When
Yeah.
an employee can exercise his right in ESOP while in possession of UPSI, unpublished price sensitive information.
yeah, the employee can exercise when he's in the possession of UPSI because it's a part of his compensation, so he can exercise. But he cannot sell those shares.
Okay, can I sell shares acquired through ESOP during the window closure period?
No, you cannot.
Okay. Do I need to obtain pre-clearance before exercising my right?
No.
Okay, whether disclosure requirement under PIT and SAST are attracted in case where shares are acquired through ESOP?
Definitely, because employees are the designated persons, so they have to abide by the PITs, and the trust also has to go for the PIT disclosures.
A very interesting point. Can I exercise my right in ESOP if I have given a trading plan and ESOP shares are not envisaged in it?
As per this, but it's as per the circular or the clarification came from the SEBI, it says that ESOPs is
Minimum
not treated as a trading in particular chapter. So then then might be because of that the employee can exercise even they have given the trading plan. But it's again not a complete clarity from the government side. But definitely he cannot sell those shares until and unless he has covered it in the trading plan.
whether contra trade restriction applies in case of acquisition or selling of ESOP shares?
No, it is exempted. Even you can exercise and sell, these are not under the contra trade.
Okay. Can we give loan to directors and employee to subscribe to ESOP? Will it attract section 185 of Companies Act?
There is a section under 67 only wherein we can give the loan to the employees, but their KMPs cannot be given the loan. So only
Madhav,
the employees can be given.
Madhav, have you given loan to your employees or people to acquire shares under ESOP?
No, we've not given any loans, but we enable loan providers to be available to our staff in case they wanted to go for loan, that they can just facilitate the arrangement and they are available to go for the loan. We don't give loans.
Okay, in shareholding pattern being filed with the stock exchange, how they are shares held directly by employees, whether they come in public or in non-promoter or non-public?
It's completely public holding.
Okay, which price to be considered for seeing the requirement of 10 lakhs disclosure under PIT? Is there a market price of the equity shares as on the date of exercise or exercise price?
Market price.
In case of graded ESOP, now is the taxable value of perquisite calculated. The fair market value each year of exercise is to be calculated on fair market value at the year of the grant is taken into account.
No, perquisite is always be at the time of exercise. So at the time of exercise, whatever is the difference between the fair market value and your exercise price will be the perquisite in your hands.
Okay, is 1% equity, 1% issued capital restriction as provided in ESOP is for the per employee or all the employee taken together?
Per employee.
Madhav, you have any different view on this?
No, one is right there.
Can equity settle SAR be settled in cash during present pandemic time?
Equity settled are converted into cash settled are. Sir, you can do in the unlisted company you can do, but not in the listed company. There is a challenge.
Okay, can we give ESOP shares to employee without giving voting rights?
Differential voting right category you can use with no voting right you can, but still in that case I think voting rights are required.
Okay, friends, now we have tried to give all the answers, but we are still receiving answers. So I will take last 3 questions. Can we issue ESOP shares to employee without giving voting rights? That I have just asked you this question.
You have covered. Yeah.
Okay. Now, can we offer DVR as ESOP in unlisted company?
DVRs.
Yeah.
So differential voting right you can, if you are fulfilling the conditions of the DVR issuance, then you can give.
Okay. Okay. So whether the minimum period of vesting can be reduced by our board or shareholders with the shareholders' approval?
Less than 1, completely no.
Can I give ESOP free of cost?
Free of cost, minimum face value. Minimum face value.
Okay, can exercise price change in future by the company after grant vesting to ESOP?
Yes, you can do. You can reprice, but shareholders' approval are required.
Can I cover my promoter and senior management person in ESOP?
Yes, you can. Senior management people you can cover. Only the restriction is that it should be it should not be related to the promoter group.
But I can't give to promoter.
You can't give.
Yeah, you cannot give to promoter, and only the startups are exempted for that.
Okay. So thank you very much, Mohini. Thank you very much, Madhav, Chandar. We have covered all the points, and still 245 people are still there. They are waiting their answers. So friends, what we will do, we have tried to give answer of all your questions, but we will compile all the FAQ and we will send it to you. Now, before concluding, I just want to thank you everyone who has very patiently attended this program, and the number is very encouraging, and the most encouraging part is that we received 150 questions. There are some questions were duplicate, so we have removed these questions and we have tried to give answer. Now what we will do, the presentation of all three speakers we will share with you. The YouTube, this video will be available on YouTube, but we will send you the link also. So all the participants will receive PPT and the YouTube link, and the FAQ we will send it to you after compiling this. So I thank all of you, and I just invite you, all of you, that we are organizing a few more webinar. One is in collaboration with SOCM. We are the knowledge partner. That is Saturday, day after tomorrow, and this is a regulatory webinar where we have requested all the regulator concerned with the M&A, and we have collected more than 100 questions to ask them on various parameters, whether it's say NCLT, SEBI, stock exchange, the income tax, and the valuation. So we will ask these questions from them, and we will do this. And after that, the corporate professional is organizing a webinar on leaning of corporate, because COVID has created that you have to reduce your cost. So the cost reduction is another way that you have a multiple companies in your group, and there's no use to continue these company. So the date we will announce you shortly, and after that we will have a one session on the PIT also, and then various other topics we will inform you. So thank you very much, friend. Thanks for your participation, and thanks Madhav especially, because you have taken a pain and addressing to all the delegates and giving answer. Thank you very much, friends. Thank you.
Thank you.
Thank you.
Thank you. Thank you. Thank you.